Hello, everyone. Welcome back to the Trading Room. I'm Shane Vernier, and this is the U.S. Mid-Session Brief FOMC Lifestyle. Today, we've got some trade ideas, and we've got a few things to go over before the big press conference here in about 10 minutes. Jay Powell's going to come out, get involved, and give his views and the Fed's views on what exactly is going on monetary policy-wise. Right now, the key things to remember are this. The Fed just held rates flat at 5.25% to 5.5%, and that is hasn't really done much to market sentiment. We're going to look at the dollar index here in a second. We've got a whole bunch of markets to look at and also some fundamentals. So let's get on with the show. Trader Mo, good to see you. How's Montana? It's fantastic. It's cold today, but it's warmer than it was. Lorianne, good to see you. I'm sure everything's going very, very well down in Florida. A couple of things we need to get started with. Let's get right out to price action here on our TST platform. You'll see we have had just an absolute plethora of patterns today. We're going to dig into a couple right now. One of these trades that I put on about 30 minutes ago, you can see we had a nice pin bar here in our gold, our spot gold market. Got in there and definitely took the bid. And you can see right now we're sort of hanging in the take profit a little bit and take profit here. So we had a nice pin bar, nice entry. We haven't quite hit our profit target yet. We're sort of oscillating around. I think Jay Powell is definitely going to be the deciding factor here. MD, good to see you. Whitveld, Alpine Cleaner, Alexa J, Montana. Yeah, Dillon, Montana. We're out in agricultural land. We're out in the country. Got out of the city about 4 months ago and feel great about it, to be honest with you. So, but if you're in a city, don't worry. You can still trade, and you probably have real fast internet, so that's a good thing as well. I do want to get right into a couple of things that we had yesterday. New month, we had a nice trade there on the U.S. Tech on this triple screen trader. You can see right there, nice pin bar, and then we went up and got our profit target relatively simply. Will the gold trade treat us that well? Oh, I don't know. I don't necessarily know that, but you can see all of the patterns that we have right here. WTI 15-minute, New Zealand dollar, U.S. dollar. For those of you that are new, this is our triple screen, a trader approach. We use support and resistance levels. We use a pattern finder, and then we drop it into our risk management module, and that gives us really a structured way to trade. We show this a lot in the trading room, so if you're not in the trading room and you're out there in YouTube land, welcome to the program, but you definitely want to check out the triple screen trader, tri-screen trader approach if you haven't already done it. I'm going to run through one very, very quickly here just to sort of give you the idea. Right here we have a New Zealand dollar, US dollar 15-minute pin bar. You see right there we've sort of seen a little bit of a retracement here. So the way we would execute is we would go right over here to our support and resistance level, or our support and resistance machine, and we would look to drop that pair right in. We would wait for our support and resistance levels, our EA to reset. Now remember, you're going to need a couple of EAs here. You're going to need your risk management EA, your pattern finder, and your support and resistance, but you definitely want to get in here and take a look at some of this stuff. And right there, it's going to be a 15-minute trade, so I'm going to focus on my 4 hour, my 1 hour. Should I be taking this trade right now? I think it's a really tall order. We've got a flat, really compressed market. We're looking at a 15-minute sell. Could I take it? You could take it. Is it the right thing to do? Well, we've got Jay Powell speaking here in about 7 minutes. It may or may not be the right thing to do, but if you get in here, you're definitely going to want to line it up with your risk manager, and if you're interested in taking that sell, you put it right beneath your pattern there. Personally, I'm going to stay out. I think Jay Powell really has a lot to say, and there's a lot to go over. So that's a good look at our triple screen trader approach. If you haven't seen it, you can see, we really do place the trades according to a pattern, and then we run it through our support and resistance levels to give us sort of that clearance, that filter. And then lastly, we go to our risk manager, we plug in our risk assessment, and then we just take the trade. We do a lot of these every single session. So if you've missed any of our action in the trading room, be sure to come on in and check it out. We got a lot going on there. In any case, we are live. I want to welcome everybody to the stream. Today is just sort of the first installment of our live coverage this week on how to trade ForexSignals. You can see right here, we've got FOMC live. That's me. That's right now. And then we've also got NFP live. That's Nick, and he's going to get in the saddle for you there Friday afternoon, or actually Friday afternoon UK time, Friday morning. Let me see, Cam 3030, what are your thoughts on oil? We'll take a look at oil here in just a second. Once Jay Powell takes the stage, we'll have a little bit of time to go over some levels. If you're trading up to par, if it's not, check out Switch Markets if you're looking for a broker. The 3 R's, we put out a video on that last week, so be sure to check that out. That tells you all you need to know about picking a broker. Our partner broker, Switch Markets, we feel is a pretty good one. So if you don't have brokerage representation in the market, be sure to check out Switch. Week 45 2024. You can see this full lineup is what we've had right here. We are on Wednesday, and we're looking at our Fed interest rate decision. Global interest rate hierarchy, that's what it's all about. Right now, the Fed is one of the global hawks. We have high interest rates. The rates were held static today, so this chart hasn't really changed. The BOE is coming up next. Will the BOE hike tomorrow? That really is the million-dollar question, the trillion-dollar question, depending on where you're at. The Fed holds firm. You can see right here, Fed interest rate decision. We held firm at 5.5. Now, remember, it's not necessarily 5.5. It's 5.25 to 5.5. The federal funds is in a 25 basis point range, so it's not 5.5. It's 5.25 to 5.5. Let's read the official statement. This is right from the Federal Reserve in the horse's mouth. Now, the Federal Reserve kept the target range for the federal funds rate at its 22-year high of 5.25 to 5.5. 22-year high. That's the second time in a row we've held rates static. So is that a dovish approach or a hawkish approach? Remember, a hawkish approach means we're restricting monetary policy. We're implementing a restrictive monetary policy, which means we're trying to contract the money supply. Boy, say that 5 times fast. Right now, we're at 22-year highs. What does that really mean to us? It means that we are trying to contract that money supply and restore pricing stability. That's key, because we start talking about the dollar and commodity prices and stocks and all of it. It really all hinges on the dollar and the relative value of the dollar. And the value of the dollar goes down when there's a lot of dollars around, and it goes up when there's a scarcity of those same dollars. So right now, the Fed is trying to create scarcity by leaving the interest rates at a relatively high level. Now, I get asked this question every day. Shane, do you think rates are high? And the first thing I say is, no, I don't. I don't think rates are high. And here's why. You can see right here, over the last year, of course, we have been raising. But look at where we're at all time. It's important to always keep these things in perspective. We've got really a range that goes from 0 all the way to 20%. This is back in the early 80s, late 70s. A lot of parallels are being drawn with the Israel-Hamas war right now from what happened in the mid-70s and the early 70s, the Yom Kippur War. Similar situation. This is, by all accounts, much more severe, but you can see exactly what happened to number one, energy prices, and number two, the global economy. So right there, you've got a big rally. Are we high with respect to 20%? No, we're not. Are we near historic lows? No, we're not really. We're way off with 0%. We're right back up pretty much where we were going into 2000, and also really going into that 2008. Now, what happened in both of those times? .com bubble, 9/11 crash. What happened here? Crisis of 2008 to 2012 crash. So we're watching this stuff closely. Historically, where are we at? What are our rate expectations? We're looking at 75% chance that we hold firm where we're at here at the December meeting. Take a look at what's going on here in 2024. It's a much different story. We've got a bell curve right there, and that really tells us that what? It tells us that we're looking for maybe static rates, maybe a rate cut, maybe some rate hikes. We don't know. We just don't know. So right now, an incredible amount of uncertainty is in the markets, and uncertainty means what to us? As active traders, it means opportunity. So with about 2 minutes left, we're going to go through a few markets here relatively quickly. U.S. dollar index right here. This is an absolute bullish pennant. When you start talking about a bull run right there, there's your flagpole. And then when you get in here and start drawing in some of these patterns, you'll see. I mean, right there is essentially your flag. It's not real pretty, but you see what I mean. Flagpole, directional move. Now we're flatlining right around 107. 107.50 is the yearly high. You got to be aware of that number going into Jay Powell's statements here. Gold. Fantastic trades on gold really all week long. We had really a nice short-term scalp off of 1988, 38% retracement. Beautiful bounce there. And then we also had an absolute killer bounce right off of 1975. We put that one out yesterday. That has been about as good of a trade as I've seen in a long, long time. We had a nice compression zone between 97 and 53. Price fell. Why did price fall? Because the dollar's appreciating in value. There's a lot to that. We're going to find out a little more from Jay here in a second. 1975 was our level. We were looking at bidding 76.50s. That one cashed in. We're looking at 1965.59. The next port of call could happen as Jay Powell speaks. Right here, 2022's high, 151.94. And I do believe that in this Japanese yen, this dollar yen, we're watching this very closely. What I would like to see is a break above 2022's high, and then we get a pullback. And once we get that pullback, then we can look to go long from that level right around 152. So I'm watching the yen closely. And then lastly, the Euro USD. Here you go. Up. Jay Powell's taking the stage. So we've got to come in here, and I got to see if I can get the sound going for you. I know I got a little bit carried away, but pretty good stuff. Got a little desktop audio. Would you please holler? Give me a thumbs up if you can hear the... Actually, he's not saying anything right now, but we should be good to go. In any case, right here, you do see this. This is an absolute epic level right here. Pattern in the Euro USD. Weekly, major bearish pennant. I'm watching the breakout very closely. If in fact this dollar index ticks higher, we may be going much lower here on this Euro USD. Watching this very closely. All right, Jay's taking center stage. If there's any audio problems, be sure to holler. I think we should be good to go.
Good afternoon, everyone. Welcome. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. Achieve labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. The stance of policy is restrictive,
1 minute chart for
meaning
gold.
that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt.
Top side resistance
Today,
at 81.
we decided to leave our policy interest rate
Watching 75 closely as
and to
support.
continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks.
Beautiful scalp right there from
I'll have
resistance.
more to say about
Watching
monetary
75
policy
closely
after
in
briefly
gold.
reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations.
GDP
In the
reading.
third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years, and immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs-to-workers gap has narrowed, labor demand still exceeds the supply of available workers.
Significant resistance.
Inflation remains
there in
well
gold.
above our longer-run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Okay, we want to hear questions about Israel-Hamas war right away. Global
Howard
supply
Schneider,
chain issues.
Thank you, Chair Powell, for doing this. To what you referenced the rise in long-term bond yields, to what degree did that supplant action by the Fed at this meeting?
Good question.
Thanks for your question. So,
watching
I'll
1975
talk about bond
close.
yields, but I want to take a second and just
gold.
sort of set the broader context in which we're looking at that. So,
Beautiful resistance
if you look at the
there.
situation, let's look at the economy first. Inflation has been coming down, but it's still running well above our 2% target. The labor market has been rebalancing, but it's still very tight by many measures. GDP growth has been strong, although many forecasters are forecasting, and they have been forecasting, that it will slow. As for the committee, we are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. And we're not confident yet that we have achieved such a stance. So that is the broader context into which the strong economy and all the things I said, that's the context in which we're looking at this question of rates. So obviously we're monitoring, we're attentive to the increase in longer-term yields, and which have contributed to a tightening of broader financial conditions since the summer. As I mentioned, persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from other sources like the stronger dollar and lower equity prices
stop-out
could
point.
matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. Things are fluctuating back and forth. That's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. The second thing is that the longer-term rates that have moved up, they can't simply be a reflection of expected policy moves from us. That we would then, that if we didn't follow through on them, then the rates would come back down. So, and I would say on that, it does not appear that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So, in the meantime, though,
so he's saying bond yields are a function of the open market,
is that these
not
higher
Fed
Treasury
policy.
yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And the mind's eye goes to the 8%, near 8% mortgage rate, which could have pretty significant effect on housing. So that's how I would answer your question.
Just as a quick follow-on to be clear on this, in your opening statement and just now, you seem to imply that you are not yet confident that financial conditions are restrictive enough to finish the fight. Is that true?
Yes, that's exactly right. To say it a different way, we haven't made any decisions about future meetings. We have not made a determination.
That's close.
And we're not, I will say that we're not confident at this time that we've reached such a stance. We're not confident that we haven't. We're not confident that we have. And that is the way we're going to be going into these future meetings, is to be,
it's
just
a fascinating level right there. Watching that one very closely.
Policy,
1975 and a quarter. I mean, we're just flirting with that entry. Serious price action here.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder, if you don't raise interest rates in December, would the presumption be that at that point that we should expect that rates are at their peak, or is there a possibility of restarting rate increases next year?
There's the
and
sell-off.
Are there any costs to taking a more
We'll see if we get any bids. A lot of selling right now. A lot of selling in bullion.
So,
dollar index back above 107.
We haven't made a decision about September. You're asking a hypothetical there, but we're going into the December meeting. We'll get, as you know,
bit of a bounce. This thing's coming off hard.
Labor market readings, some data on economic activity, and so we'll be taking, and also the broader situation, the broader financial condition situation, and the broader world situation. We'll be looking at all those things as we make a decision in December. We haven't made that decision.
It's like this thing's going to get taken out. If we take out 72.50, we're going a lot lower.
The idea that you would
out.
Be difficult to
brutal
raise
trade
again
out.
After stopping for a
great
minute,
resistance up here.
Right. I mean,
took out support. Now we're just sort of mucking around.
Is appropriate at the time. And again, we haven't made any decisions at all about December. We didn't talk about making a decision in December today. Really, it was a decision for this meeting and
go right to the weekly.
Things.
1933, of course, is a premium entry, but we're not going to get that more than likely.
Chair Powell, did the Fed staff put a recession back into the baseline forecast in the materials for today's meeting? And how much does this tightening in financial conditions substitute for rate hikes if the tightening is persistent? You had said it was worth maybe a quarter point.
Huge level, 1965 is the next port of call.
What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the recession, but the answer is no. I think I have to answer it since we did publicly say in the minutes. You'll know anyway in the minutes. The staff did not put a recession back in. I mean, it would be hard to see how you would do that if you look at the activity we've seen recently, which is not really indicative of a recession in the near term. In terms of how to think about translation into rate hikes, I think it's just too early to be doing that. And the main reason is we just don't know how persistent this will be. You can see how volatile it is. Different kinds of news will affect the level of rates. And I think any kind of an estimate that was precise would hang out there and have a great chance of looking wrong very quickly. So
that's a big time zone right there, 1965, 78%.
Have clearly
and also we've got a moving average of 64.88. That's what we're looking at here in gold. Gold is definitely the market to be watching right now.
And over
tremendous
time, that will
move.
have an effect. We just don't know how persistent it's going to be, and it's tough to try to translate that in a way that I'd be comfortable communicating into how many rate hikes that is.
If I could follow up, I guess what makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far?
Well, that's the way our policy works is, and sometimes it works with lags, of course, which can be long and variable. But ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see If you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to achieve maximum employment and price stability, and so we take the economy as it comes. It has been resilient, so we take it as it is.
Thank you. Colby Smith with the Financial Times. In terms of the thresholds that you've laid out of what could warrant further tightening, the additional evidence of persistently above trend growth. Or
Fifth
some
question,
kind of
not one question about geopolitics and the impact of the Israel-Hamas war. Not one question.
More powerful than just one more quarter point.
The press corps has been told not to ask that question.
And I'm just curious.
You have to
if
ask
that's
that
how
question.
The committee sees
That
it.
is the question.
So we've identified those factors. Those are not meant to be the only factors or a specific test that we're going to be applying with some metrics behind it. Really, we're going to be looking at the broader picture, and what's happening with our progress toward the 2% inflation goal. Is the labor market continuing to broadly cool off and achieve a better balance? We'll be looking at that. Growth. We look at growth insofar as it has implications for our 2 mandate goals. We look at that, and we look at broader financial conditions. So we'll be looking at all of those things as we reach a judgment. Whether we need to further tighten policy. And if we do reach that judgment, then we will further tighten policy.
Okay. And just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially, again, raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So the fact is, the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is, have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be, for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident.
Bearish pennant, bearish flag
is on a sustainable path down to 2%.
Coming
That'll
off.
be the next question. But
That's
honestly,
textbook
now,
right there.
we're really
Run, rotate,
tightly focused
break.
on the first question. The question of rates cuts.
This
just
is why they
doesn't
make
come up
stop
because I
losses
think
right
the
here.
first- it's
Get
so
out,
important to get that first
regroup, come
question,
back strong.
as close to right as you can.
Steve Leisman, CNBC. Mr. Chairman, I guess I had assumed that there was a tightening bias in the committee. You say in the statement you're looking to assess the appropriate stance of monetary policy, the extent to which you may need to hike additionally. You didn't say earlier that you were sufficiently restrictive. There were forecasts for 2 rate hikes among most members of the committee. But then you just said that, we haven't made a determination. Would you say the bias right now is neutral, that there is no disposition to hike again, and that the committee largely has moved off of this forecast for 2 hikes? Or for, I'm sorry, 1 additional hike?
I think you're talking about 1 additional.
Yeah,
I wouldn't say that at all. I would say, the language, looking at it here, in determining the extent of additional policy firming that may be appropriate to return inflation 2% over time. That's the question we're asking.
So is it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking: is should we hike more? It's not, and that is the question. And you're right that in September we wrote down 1 additional rate hike, but we'll write down another forecast, as you know.
Why is that off the board now, Jay? Why? They're dodging the question. Ask the question.
Thank you, Chris Rugaber at Associated Press. Well, since the last meeting, the auto workers' strike has finished. Oil prices have leveled off. And yet, on the other hand, you have the outbreak of war between Israel and Hamas. How do you see all those factors taken together affecting the economy going forward? How are you thinking about this?
This is the question.
So there are significant issues out there. As you point out, global geopolitical tensions are certainly elevated, and that goes for the war in Ukraine. It goes for the war between Israel and Hamas. We're monitoring that. Our job is to monitor those things for their economic implications. So, The UAW strike, as you point out, appears to be coming to an end. Oil prices have flattened out. They haven't gone down, but I guess they've gone down a little bit from their earlier peak. Another one is the possibility of government shutdown. We don't know about that one. So there's plenty of risk out there. But I would go back to the bigger picture from our standpoint is we've got a very strong economy, strong labor market, making progress on the labor market, making progress on inflation, and we're very focused on getting confident that we have achieved a stance of monetary policy that is sufficiently restrictive. That's really our focus.
Great. And just one quick thing. You last month had gone to York, Pennsylvania, where you talked to last month, where you talked to a lot of small business owners. Just curious, what sentiments did you hear from them, or what did you picked up on, and was there anything that surprised you the most in terms of what they talked about?
I wouldn't say I was terribly surprised. I was very impressed by York as a town with a real strategy, and I would say it's very impressive what the people there have put together in the face of some difficult longer run trends about offshoring of manufacturing and that kind of thing. They've done a great job as a city, I think. What you hear, and is consistent there, which is people are really suffering under high inflation. You were there. We talked to some people who, were feeling that in their businesses, and other people who were feeling it in their home lives as well. It's painful for people, particularly people who don't have a lot of extra financial resources, who are spending most of their income on the essentials of life. So we know that wasn't new, but that did come through very clearly in the conversations we had in New York. And I walked away from that even, just thinking that we really the best thing we can do for the U.S. is to restore price stability.
Key zone right there at
fully restore price
75.
stability and
We
not
may not be
fail
done
in
with
that
it yet.
task, and do it as quickly as possible. But
Still
but
bearish
also with
here,
the
though.
least damage we can.
Dollar yen. When you look at the dollar yen, we're still beneath that 151.94 area.
Hi, Chair Powell.
Watching
Rachel
this one
Siegel from
closely.
Washington Post. Thanks for taking our questions. You've spoken before about the pain that would likely be coming for the economy in order to get inflation down. But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
Well, I think everyone has been very gratified to see that we've been able to achieve, pretty significant progress on inflation without seeing the kind of increase in unemployment that has been very typical of rate hiking cycles like this one. So that's a historically unusual and very welcome result. And the same is true of growth. We've been saying that we need to see below potential growth, and growth has been strong, but yet we're still seeing this. I still believe, and my colleagues, for the most part, I think still believe that it is likely to be true. It is still likely to be true, not a certainty, but likely that we will need to see some slower growth and some softening in the labor market conditions to get to fully restore price stability. So, but it's only a good thing that we haven't seen it, and I think we know why. Since we lifted off, we have understood that there are really two processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic, and the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover, time and space to recover. So you see those two forces now working together to bring down inflation. But it's that first one can bring down inflation without the need for higher unemployment or slower growth. It's
Weekly oil chart.
Supply side improvements like shortages and
Monthly.
bottlenecks and that kind of thing going away. It's
key to know the big
a
picture.
significant increase
Anchor
in the
point.
size of the labor market now, both from labor force participation and from immigration. That's a big supply
Moving
side,
average.
Gain.
Throw
that is
50%
really
away.
helping the economy, and it's part of why GDP is so high.
75.59, beautiful support. 70.28, even better.
But I think
80.51.
those things will run
Don't
their
love
course, and we're probably still going to be left. We think, and I think, we'll still be left with some ground to cover to get back to full price stability And that's where monetary policy
Compression,
and what we do
break.
with demand is still
Got to be
important.
bearish toward crude right now, in my view.
Against that backdrop, if you've gotten any clarity on lags,
Back to
if
our
you have
1 minute
an economy that's
gold.
been so resilient to high rate increases, does that suggest to you that there isn't necessarily this huge wave of tightening that's still coming through the pipeline and that it may have already come into effect?
You know, I continue to think it's very hard to say. So it's been 1 year at this meeting. 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the effects of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you can, for example,
How do you know you're seeing it if you know what
is
come on.
debt that had been turned out. But it's going to come due and have to get rolled over next year or the year after. So, and there are little things like that where the effects are just taking time to get into the economy. So, I think we have to make monetary policy under great uncertainty about how long the lags are. I think trying to make get a clear
uncertainty
answer
about how long our policy is going to take
is really
effect.
not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy. And it takes time, we know that, and you can't rush it.
So we need to be patient.
Slowing down is giving us, I think, a better sense.
Be patient with $7 loaves of bread.
How much more we need to do if we need to do more.
We're fresh out of patience, Jay.
Michael McKee from Bloomberg Television and Radio. I'm trying to connect the dots here. One quick clarification I want to ask about Rachel's question is, you said you need slower growth. You had always said before a period of lower than trend growth. Has that changed? And two, it sounds to me like you're basically saying here that the dot plot's out the window, that every meeting is live with the possibility of a rate increase for right now. It doesn't matter about the turn of the year, and that there's not an objective way to determine whether or not you've got enough tightening in the system. It's just going to be a subjective judgment meeting by meeting.
That's exactly what they said. Data dependent.
Let's talk about the dot plot first. So the dot plot is a picture in time of what the people on the committee thinks is likely to be appropriate monetary policy in light of their own personal economic forecast. In principle, when things change, that's not like a plan that anybody's agreed to or that we will do. That's a forecast that would change. For example, I mean, many things could change that would cause people to say, I wouldn't write down that dot, 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period between that meeting and the next meeting. But nonetheless, it's out there, and we do personally update our forecast, but we don't formally update the dot plot. So, I think we try to be as transparent as we can about the way we're thinking about these things. We're laying out there.
Those are stop
thinking,
bidding
and,
here,
as we
stop
approach
here,
the meeting,
and now you've got the rallies
my colleagues
on.
and I will be talking about how we're processing that
That's
data.
a tough trade to hold.
In terms of, we're not really changing the way, in terms of growth, what I said was below potential. So what you have here recently is growth that is temporarily, potential growth is elevated for a year or two right now over its trend level. So the right way to think about it is what's potential growth this year. People think trend growth over a long period of time is a little bit less than 2%, or I would say just around 2%. But what we've had is with the improvement in the size of the labor force, as I mentioned, through both participation and immigration, and with the better functioning in the labor market, and with the unwinding of the supply chain and shortages and those kinds of things, you're seeing actually elevated potential growth. There's catch-up growth that can happen in potential, and that means that if you could be growing at 2% this year and still be growing below the increase in the potential output of the economy. I hope that's clear. That's really what's going on.
I'm a little
why I would say
foggy,
it
Jay.
Below potential.
What's potential growth and
clarify what I asked
growth?
about meeting by meeting. Are we essentially down?
Growth rates are all
supposed to
assumed and
it's a meeting
projected.
by
So what
meeting,
exactly is a projected
live meeting
growth
with a
rate?
chance of a rate increase
Lost me
that
there,
would be
brother.
decided on subjective criteria rather than objective. at each
75's
meeting?
huge for gold right now. Huge. This market's loading up at that level.
I don't know that I want to just accept anybody's characterization of it. I'll tell you how we're doing this. So we're going meeting by meeting. we're asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive
So you
to
got US
bring
100.
inflation down to 2% over time. That's the question we're asking. We're looking at the full range of economic
Daily
data,
US 100.
including financial conditions and all of those things that we look at. And
Bullish.
then
We're looking to bid this thing.
You know, we've come very far
30
with this
minute.
rate hiking cycle, very far. And you saw the spread at the September meeting of, you know, it's a relatively small spread of people think 1 or 2
5 minute.
additional hikes. So you're close to the end of the cycle. That was an impression a belief as of September.
Daily
It's not a promise or a
62%.
plan of the future.
We're
And
going
so
higher.
We're going into these meetings one by one. We're looking at the data. As I mentioned, we're also
Pushing session highs.
We're being careful. We're proceeding carefully because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly in interest-sensitive spending and other channels. So that's how I think about it.
Monthly U.S. tech.
Thanks. Hi, Chairman
All-time
Powell. Neil Irwin
highs.
with Axios. In light of the run-up in long-term yields we've seen the last
Fairly
several weeks,
bullish.
have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be a reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering. And I know there are many candidate explanations for why rates have been going up. And QT is certainly on that list. It may be playing a relatively small effect, although I would say at $3.3 trillion in reserves, it's not. I think it's hard to make a case that reserves are even close to scarce at this point. So that's not something that we're looking at right now.
Have to ask about the Treasury auction from today.
Hi, Victoria Guido with Politico. I wanted to ask about the Basel III endgame capital proposal. You've gotten a lot of pushback from people on different aspects of the
heck's
proposal, and
that?
you yourself expressed some reservations. And I'm just curious, could you accept finalizing that proposal without significant changes?
So that proposal is out for comment, and we expect a lot of comment. We won't get those comments until the end of, until well into next year. We've extended the deadline, and we'll take them seriously. We'll read them. I'll say what I do expect is that we will come to we're a consensus-driven organization. We'll come to a package that has broad support on the board.
So does broad support mean more support than the proposal had?
It means broad support.
VM Capital Management. I
Marte
don't
with
know what
Bloomberg.
Powell is saying.
So,
that makes two of us, VM. He's talking in
In addition
circles.
to persistence, when you look at long-term Treasury yields, what else are you watching to evaluate how those tighter financial conditions are hitting the economy, and if it will lessen the need for further tightening? Also, do you think that those higher yields could affect banking stress?
So what do we look at? We look at a very wide range of financial conditions. And in fact, as you'll know, different organizations publish different financial conditions indexes, which can have 7 or 8 variables, or they can have 100 variables. So there's a very rich environment, and we tend to look at a few of them. I'm not going to give you the names, but they're the few
Dollar,
of the
yen.
common ones that people look at. And so they're looking at things like the level of the dollar, the level of equity prices, the level of rates, the credit spreads.
Still ways to support.
Sometimes they're pulling in credit availability and things like that. So it isn't any one thing. We would never look at, for example, long-term Treasury rates in isolation, nor will we ignore them. But we would look at them as part of a broader picture, and they do play a role, of course, in many of the major standard financial condition indexes. Your second question was banking stress. So it's something we're watching. As you know, we did have there were issues with interest rate risk and also funding uninsured deposits in the March, the things we went through in March and thereafter. And so we've been working a lot with financial institutions to make sure that they have good funding plans and that they have a plan for how to deal with the kind of portfolio unrealized losses that they have. We do think the banking system
1 minute
is
chart.
quite
There was your
resilient.
Fed
We had,
announcement right there,
a
that
handful of bank
craziness. And we
failures,
traded
but,
inside. Our
so
presser
that's what they're
rejected
doing.
resistance,
And,
went through support, based,
We don't have any
We're headed
reason to
right
think
back
that
for the
this-
bat,
that
right
these
back
rate
there to
hikes,
1979.
are materially changing that
That's why
picture, which
trading
one
these
of a
things is
strong
brutal.
banking system, and one where there's a strong focus by banks and by supervisors on liquidity, on funding, and those sorts of things.
Thanks, Mr. Chairman. Scott Horsley from NPR. Last week, you and your colleagues put forward a proposal to lower the cap on debit card swipe fees for comment. Could you just talk a little about the considerations there, what it would mean for merchants, for banks, for consumers, and also just what y'all are seeing in terms of the use of both
what are
debit
y'all
and credit
seeing?
cards in the payment system?
You know, so you're right. We put a proposal out for comment is what we did, and you know this is a job that Congress assigned us, as you of course know, in Dodd-Frank, and all we can really do is faithfully implement the statute. That's all we're trying to do. What else can we really do? It's a 90-day comment period. We typically don't comment on these things once they're out for comment, and we do hope that stakeholders, and we know that they will use this opportunity to express their views. They haven't been shy about that. So that's critical, and that's what I can say about that now.
That was a nothing answer.
Thank you.
This
Thanks,
is a
Chair.
tough presser
Edward
for
Lawrence
Jay.
with Fox Business. So over the last 3 months, the year-over-year PCE inflation was at 3.4%, core well over 3%. You've said in the past 2% remains the Federal Reserve target, but with no rate increase today, how long would you be okay then with a 3% or 3% plus overall inflation?
You know, the progress is probably going to come in lumps and be bumpy, but we're making progress. You know, I think the core PCE came down by almost 60 basis points in the third quarter. So the best thing I could point you to would be the September SEP, where you know the expectation was that inflation by the end of next year on a 12-month trailing basis would be well into the twos, and the year after that further into the twos. So that's if you look historically,
so give me another
sort of
year.
consistent
That's what he
with the
just
way
said.
inflation
I
comes
need
in.
another
It does
year.
take
We
some
need another
time.
year for this to
And as
work
you get,
itself out.
You know, as you
another
get
year
further and further from those highs, it may actually take longer time. But the good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do.
Well, you've said in the past that doing too little on interest rates could take years to fix, but the cost of doing too much could be easily fixed. How robust was the debate about this pause on the doing too little side?
That's always the question we're asking ourselves, and we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy, and we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription for misery, and so we're really committed to not letting that happen. You know, for the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks have gotten more two-sided. You can't identify that with a lot of
So
precision.
the more you
but it
do,
does
the more
feel like
riskier it
the
gets.
risks are-
You had a
are more
one-sided risk,
two-sided
now you have a
now.
two-sided risk.
But we're committed
Maybe you
to
guys ought
getting
to
inflation
stay out
back
of
down
it.
to our target over time, and we will.
And we will.
Simon Rabinovich
And
with
we
The
will make it
Economist.
so.
Quick follow-up to the question about banking stresses.
Says who?
You talked about how the banking system is resilient. Of course, part of the resilience of the past year stems from the bank term funding program that you launched in March. Given that bond prices have not recovered, that unrealized losses are probably mounting, how likely is it that you might have to extend that program in March next year?
Good question. We haven't
Good
really.
question.
We
We don't
haven't really
know.
been thinking about that. You know, it's November.
Great
1,
question. We
and that's a
just don't
decision
know
we'll be
yet.
making in the first quarter of next year.
Okay. Sorry, quick separate question about inflation expectations. The Michigan Sentiment Survey showed a big jump in 1 year ahead inflation expectations last month from 3.2 to 4.2. Last year, you said that particular survey was a really decisive factor in one of your rate hike decisions. If it stays elevated next time
Sorry,
around,
Alex, it's
how big of
funny.
an input will that be into your December thinking?
Yeah, we look at a range of things. I think the UM thing got blown out of proportion a little bit. It was actually a preliminary estimate that got revised away, and I said it was preliminary in that, but that didn't get picked up. So we look at many things, and so really look across the broad array of surveys and also market-based estimates, and and we do that really carefully at every meeting and between meetings. And it's just clear that inflation expectations are in a good place. The public does believe that inflation will get back down to 2% over time, and it will. They're right. So, and there's no real crack in that armor. You can always find
I would
one
debate that point.
reading
I don't think
that
the
is a little
public
bit out of
believes
whack. But honestly, the bulk of them are just very clear that the public believes that inflation will come down, and that's, of course, we believe that's critical in winning the battle.
Boy, I don't know about that one, partner.
Hi, Chair Powell. Megan Casella with Barron's. Thanks for taking our questions. I wanted to see if you could talk about the neutral rate. You mentioned today that you're still debating whether rates are sufficiently restrictive, and you've recently said that evidence is suggesting policy is not too tight right now. So I was curious if you could elaborate on that at all and whether that means the neutral rate, in your view, has risen.
Yeah. So first thing to say is that it's very important. It's a very important variable in the way we think about monetary policy, but you can't identify it with any precision in real time, and we know that. So you have to just take that. You have to take your estimate of it with a grain of salt. What we know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or attempt to sort of agree as a group on whether R-star has moved or not. Some people think it has. Some people haven't said that don't think it has. Ultimately, it's
There's the initial
unknowable.
move, that range,
And so
that box up there.
Really, again, what we're focused on is, looking at the data and giving ourselves a little more time now to look carefully at the data by being careful in our moves. Does it feel like monetary policy is restrictive enough to bring inflation down to 2% over time? That's the question we're asking.
That box
ourselves.
was the range of the announcement itself. Look where we're at.
Years
We're right
from now,
back there.
Economists will be revising their estimates of R-star as it existed on November 1, 2023. We can't really wait for that in making policy. We have to look. We have to have those models and look at them and think about them. And ultimately, we've got to look at the effects that policy's having, accounting for the lags, which makes it difficult.
If I could follow up on a wages point earlier, you talked about the inflation outlook, but I'm curious if you have any concerns whether wage inflation at its current level could risk pushing up overall inflation or reacceleration.
So if you look at the broad range of wages, wage increases have really come down significantly over the course of the last 18 months to a level where they're substantially closer to that level that would be consistent with 2% inflation over time, making standard assumptions about productivity over time. So it's much closer than it was. And that's true of the ECI, which is the one that we got this week. It's true of average hourly earnings and compensation per hour too. So, and all of them are kind of saying that, which is great. And you have to look at a group of them because any one of them can be idiosyncratic in any given reading. So that's what you see. And so what you saw with the ECI reading was, if you look back comes out 4 times a year. If you look back a couple of quarters, you'll see it was much higher, and then it came down substantially in June. And then the September reading was more or less at the same level as the June reading. So in a way, it's just validating that decline. And it was very close to our expectations internally too. So I think we feel good about that. Also, I would say it isn't, in my thinking, it's not the case that wages have been the principal driver of inflation so far. Although I do think it's fair to say that as we go forward, as monetary policy becomes more important relative to the supply side issues I talked about and the unwinding of the pandemic effects, it may be that the labor market becomes more important over time too.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, are you now as concerned about overshooting and raising interest rates too much as you are about getting inflation down to the 2% target?
So as I mentioned, I think for much of the last year and a half, the concern was not doing too much, not doing enough. It was not getting rates high enough in time to avoid having inflation expectations, higher inflation expectations, become entrenched. So that was the concern. I think we've reached now more than 18 months into this. You can see by the fact that we have slowed down, although we're still trying to gain confidence in what the appropriate stance is. But you can see that we think, and I think, that the risks are getting more balanced. I'll just say that they're getting more balanced. The risk of doing too much versus the risk of doing too little are getting more closer to balance, because policy is I think clearly restrictive at 5.25% to 5.5%. That range, if you take off a mainstream estimate of the expected inflation, take 1 year inflation, you're going to see a real policy rate that is well above mainstream estimates of a neutral policy rate. Now that's arithmetic. It doesn't really, what the proof is really in how the economy reacts. But I would say that we're in a place where those risks are getting closer to being in balance.
And you said the proof is how the economy reacts. What are you looking at to be sure you're not overshooting?
Well, I think what we're looking at is, is inflation still broadly cooling? Is it sort of validating the path we saw over the summer, where inflation was clearly cooling and coming down? Now, we've seen periods like that before, and there hasn't been follow through. The data have bounced back. So what are we seeing? Are we seeing, is inflation still coming down? So that's the first thing. Second thing is, in the labor market, what we've seen is a very positive rebalancing of supply and demand, partly through just much more supply coming online, and with labor demand still clearly remaining very strong. When you have the kind of job growth we've had over the last quarter, it's still very strong demand. So, and you see wage increases coming down, as we discussed, but coming down, in a kind of gradual way. I think we want to see that whole set of processes continue.
Brian Mena, CNN. Do you think that has been any structural change in either consumption or in the job market that's pushing up consumption? You obviously saw the third quarter GDP figures, which were strong, and some economists have expected revenge spending to have fizzled out by now. So I'm kind of wondering if there's been any structural change in consumption.
I wouldn't say there's been a structural change in consumption. I would say it's certainly been strong. And so a couple of things. We may have underestimated the balance sheet strength of households and small businesses, and that may be part of it. There may be, we've been, like everyone else, trying to estimate the amount of savings that households have from the pandemic when they couldn't spend on services really at all, or in-person services. And, there can still be more of that than we think, although at a certain point we're going to be getting back to pre-pandemic levels of savings. We may not be there yet. So clearly people are still spending. The dynamic has been really strong job creation, with now wages that are higher than inflation in the aggregate anyway. And that raises real disposable income, and that raises spending, which continues to drive more hiring. And so you've had that whole dynamic has been, and also at the same time, the pandemic effects are wearing off, so that goods availability, automobile availability is better, or was better. I think it still is. And from a business standpoint, there are more people to hire, and there's more labor supply. So the whole thing has led to more growth, more spending, and that kind of thing. And it's been good. And the thing is, we've been achieving progress on inflation in the middle of this. So it's been
we're going to look at the numbers here in a second,
how long can that continue?
About your inflation.
I just think the existence of this second set of factors at this time, which is the unwinding of the pandemic effects, that's what makes this cycle unique, I think. And we're still learning. That took
3 years
longer
later
for that process to begin than we thought. and we're still learning about how it plays out. That's all we can do.
So to Daniel for the last question.
Last question. Thank goodness.
Thank you, Chair Powell. Daniel Avis from
One
Agile
question,
Response Press.
27 parts.
Just a quick question following up on an earlier one with regards to the Israel-Hamas conflict.
All right.
The Fed's financial stability report said that Israel-Hamas conflict and the conflict in Ukraine pose important risks to global economic activity, including the possibility of sustained disruptions to regional trade in food, energy, and other commodities. You've had organizations like the World Bank warning of a possible surge in oil prices if the war spreads to other countries in the region. I'm just wondering how the Fed is monitoring these developments in the Middle East. You mentioned they are, and just what the potential economic impact could be if the conflict does spread to other countries in the region.
Best question of the day by far.
I wouldn't want to speculate
It took
too
us
much.
an hour to
I'll
get
just
here.
Say, so, really the question there is, does the war spread more widely, and does it start to do things like affect oil prices in particular, since this is the Middle East we're talking about? The price of oil has really not reacted very much so far to this. As the Fed, as the Federal Open Market Committee, our job is really to understand the economy and the economic effects. And it isn't clear at this point that the conflict in the Middle East is on track to have significant economic effects. That doesn't mean it isn't incredibly important.
Wow.
And something for people to take great, really
Says
important
it's not a big
notice of,
deal
but
economically.
It may or may not turn out to be something that matters for the Federal Open Market Committee as an economic body. But what the Financial Stability Report does is it calls out risks, and that's what it's doing, is calling out a risk of that. And the war in Ukraine, the same. War in Ukraine, did have immediately very significant macroeconomic implications because of the connection to commodities. So, thank you. Thanks very much.
Completely skirted that question. Unbelievable. Well, best question of the day was the last one. As far as, what can we really say about our interest rate expectations? Are they coming down? Are they going up? I mean, nobody really knows at this point going into 2024. But what I will say is, when you start getting into price action, we really saw a fantastic lesson here live. We just put the gold chart up because it gave us everything we needed. Take a good look at what happened right here. This is when the Fed made its announcement that, okay, it was going to hold rates firm. That was at about 2 o'clock Eastern. Big rally. Then we filled that candle in, and then we went sideways really until Jay Powell started talking right in here. And then we saw the failure up there at our resistance zone. Feel free to look at the stream again. And then the big sell-off, and we were looking at bid and 75s, somewhere in there. That trade got swept out of the box before you finally based out down here at 69, and then you've rallied right back up to where we were. Now this is textbook. This is textbook FOMC day. This is textbook Fed day trading. You don't necessarily ever get a direction out of these markets. Now we're up, we're down. We get all that. We understand all that. But look at where you're at. I mean, we just went on a major move. These are derivative products. If you're bidding gold with any kind of size, you're on the hook for a lot of money. Well, the big question is when do I get out? And that's why we had a stop loss in there. We said, you know what? Rip the Band-Aid off. And at this point, we were down there right around at 72. I believe it was 46 was our stop. We bid it right up here. We got swept out relatively quickly, saw a little bit of a base, and then we kept going down. We continued our sell-off down there to 69.91. At this point, you look at the chart, and it's easy to hit yourself in the head and clap your hands and go, I should have stayed in. I should have stayed in. The market always comes back. That's not true. That is not true. I would much rather just rip the Band-Aid off and take my loss than sit there with my fingers crossed at 69 while Powell is making statements. I would much rather rip the Band-Aid off, get the heck out. Your first loss is your best one. As soon as I exit the trade, I don't care what the market does. Immediately, we stepped back. We looked for other levels. We game plan moving forward. We didn't just get really married to a trade that may or may not come back in our favor. If you're still holding longs down here at 69 and you bought 75s somewhere up in there, boy, you're hoping price comes back, and that typically is always a loser. It's always a loser. Now, did it come back? Yeah. Did we think it was going to react from 75? Yeah, we did. We were wrong. Came right back up into that same zone. Do we go higher or lower from here? My guess is we settle right there. So that's what I would say about gold. As far as the rest of this stuff, I do want to highlight this dollar yen. This is huge. I would absolutely love a pullback from this zone and have an opportunity to buy some more down there at 146. That's light years away. At this juncture, we're looking for something really to break. Let's go to a 4-hour chart. This is one of the ones that's on my radar. You really are looking here hard at getting a 4-hour break above last year's high, 2022's high. Then we can step up and maybe bid a retracement. That's a beautiful thing. I would absolutely love to do that. So that's what I would be looking at there. Now, as far as this Euro USD, you can see long-term bearish, sort of a bearish pin. And I know it's not the prettiest thing in the world, but you can see we're still in consolidation here on a weekly chart. So do we go down? Do we go up? Really, really hard to say. For me, I'd be in an absolute holding pattern here. I did get a question during the live stream, though, about the Great Britain pound US dollar, and I'll do a quick synopsis on this. You can see I've sort of got all my stuff already planned out there, but let's go ahead and just do a quick top to bottom. This is a method that I've used for a long time, something I used to do a lot on live streams, but in any case, you can see right here, you look exactly what you have. You have a nice big rally since October of 2022, and now we've got a pullback. So the real question is what should I be looking to do here with the pound? Remember, BOE is coming up during that overnight. Key level right there is 120.86, 78% of that spike low to that spike high, and we got a nice bounce north right there to 121.51. So I'd be looking at downside support at 120.86. As for right now, what would I be looking to do, say on like a daily or something like that? Absolutely nothing. That's what I call a picket fence. You came down. We've just this area has been just robust support, realistically going back to the the 3rd of October. That's a huge level. That's an absolutely huge level. So I'd keep an eye on that going to the BOE. Remember, BOE during the overnight, that's an absolutely huge release, and you want to make sure that you don't miss it. As far as what I would say is important with regards to what Jay Powell said, I'll do a quick recap for you. Our rate expectations are everything here. As far as what I think about his view of what inflation's done. I'm going to go through the numbers light speed here because it's time to go. But I'll tell you what, 78% we're thinking. In December, we're going to hold firm here at 5.25 to 5.5. We don't see rates going up again this year. Take a good look at this. Inflation's gone way down, right? We've made incredible progress. We could see the build. This is the PCE number that he was talking about. And then you saw the big drop down to 120 back in May. And now look. You've got an upward trajectory again. So the idea that it's gone down and it's going to stay down, that's not necessarily the case. We saw a major shock to this number back in May, and now we're on the uptick north. Take a look at what's happened to PCE. See, I would really take an issue with the PCE readings. You can see right here, we've been on just an incredible trajectory. The CPI readings. We've been on an incredible trajectory in CPI. Realistically, the entire year, this is the raw data CPI number. It has not wavered. It has not changed. So, yeah, we could go back and say, yeah, we made some progress in PCE, personal consumption expenditures, but we could go to our CPI, our consumer prices themselves. Those things have been going north for a long, long time. So I don't see really much progress at all there. Then again, I don't have a PhD and I'm not in the boardroom. Maybe they should put a few of us normal folks in the boardroom and we can maybe get somewhere with saying, hey, just because your fancy number says that inflation's way down, the price of bread and eggs is still way up. So I really take issue with that idea that we're making progress and we're getting there. I don't see that. I see a major shock to the system, but potentially an outlier, and then you've got the upward trajectory again. So you hit it on the head, and it's coming right back. I don't buy that. I don't buy that argument at all from Jay Powell. I think that he's categorically false, and I think that the Fed right now is trying to buy time. So, all right, guys, we're going to leave it there. I mean, we've been on for plenty of time. I hope you enjoyed the coverage today out there on YouTube. I had a great live chat going there. I had great questions here. MD, yep, with you on that, Shane. Yeah, I'm not buying it at all, MD. I think that inflation's out of control, and until I see the Fed put the rabbit back in the hat, I'm not buying it. I'm just not buying it. So if your trading's not up to par, take a look at Switch. If you need a broker, get involved in the Forex and CFD trading. Switch markets, fantastic destination. Check out the website. Go there. You're definitely going to want to reach out to the live support, see if they can help you. Ask questions. Always remember, if you're choosing a broker, ask questions. Never stop asking questions. Ask about commissions. Ask about spreads. Ask about account minimums. Ask about their platform. Same goes for everybody in the room. Be sure to ask me any questions you'd like. Send them over via private chat. I'll do my best to get back to you. I want to thank you again for joining me today. Those FOMC pressers are always a bit of a challenge because you don't want to talk over everybody, but you also want to highlight some trade ideas and give some analysis. The big thing I would take away from today's engagement is the Fed is lost. They're uncertain. There's a lot of uncertainty. And the other thing that I would take away from this right now is this. I don't know everything. When I'm just talking from a decade of experience. I have a degree in a bachelor's of finance that I got about 20 years ago. I've been in the world of finance my entire life, but I don't know what it's like to sit in those boardrooms, and I don't know what it's like to weigh all the evidence that they're seeing. But I can tell you a lot by the questions that were asked. And those reporters in that press pool made sure that they did not ask about the Israel-Hamas war right away. They didn't want to talk about it. And the last question of that entire press conference was the best one. And if you watched how Jay Powell answered it, he sidestepped it completely. Said it's not a big deal yet. And he knows damn good and well it is a big deal. If that war spreads within the region, within the Middle East, if the U.S. gets involved, if Iran gets involved, if it mushrooms like a lot of analysts think it's going to, it's game, set, and match, and monetary policy, whatever they think they're going to do in 2024 goes out the window, and it's a whole new ball game. So not to scare anybody, we're here to trade. We're not here to be political science people, but they completely dodged that question. It's the number one market driver in the world right now. All right, everybody, I want to thank you for joining me yet again. I have a fantastic trading session. We'll see you back here tomorrow. Remember, BOE during the overnight. Be watching that pound. We'll be back tomorrow with the state of U.S. labor. I'm going to break down the labor. We're going to get you nice and prepped and ready to go for NFP on Friday, NFP Live with Nick Quinn. All right, everybody, until next time, trade the action well, and we will talk soon. See you.